traders, and welcome to a new day trading strategy video of mine. In today's video, we're going to be talking about a type of analysis that I haven't really talked about yet on my channel, arbitrage. So I've talked about technical analysis, we've talked about sentiment, we've talked about fundamental analysis. We haven't really talked too much about inconsistencies in the market and how to make money off of scalping them. Just to preface, this type of strategy is good for traders who like fast action and who prefer high risk reward strategies. This is not really meant for a trader who likes to take his time and be patient. With basically every other trading strategy, you're going to want to be patient. With this strategy, you're actually going to want to be more trigger happy. I'm going to show you guys exactly why I mean that. So what is arbitrage? Well, as you might have noticed, different exchanges are going to be listing different prices for Bitcoin. Some exchanges will act as leaders and some will act as followers. So currently, Bitfinex is the leading exchange, where many other exchanges are going to conform their price to match Bitfinex. An example of this would be GDAX. So if you may have ever noticed, the Bitfinex rate is going to be moving slightly before the GDAX rate moves. And why this is occurring is because Bitfinex has higher volume and higher liquidity than GDAX does. GDAX Coinbase is the same thing, just different ways of trading it. In GDAX Coinbase, typically has a lot of bots and a lot of retail traders, whereas Bitfinex has a whole host of different kinds of traders. So basically, if you were to imagine you had two accounts and you wanted to invest in Bitcoin at the present moment, and if, let's say, the Bitfinex rate was 1% lower than the Coinbase rate, you'd probably want to buy on Bitfinex and not buy on Coinbase GDAX, because you'd be making a 1% higher profit. That would compound over time. The same goes with scalping these inconsistencies in the market, except what we're doing here is actually looking for when these rates diverge. So when the correlation actually does not become as one-to-one correlation, we're trying to trade so that we can actually trade into that one-to-one correlation. And I'm going to show you guys exactly what that means. So there are two ways that we can do this. And the first way is by using the correlation coefficient. So if you just want to pause the video for about 5 seconds here to read this, you can go ahead. But in the meantime, let's go over exactly how to get the correlation coefficient. So the first thing you're going to want to do is type in correlation coefficient right here. And you're going to want to have Coinbase, GDAX, or maybe some other exchange that is not Bitfinex up. Look for BTC USD to Bitfinex here, leading exchange. And my kind of style, as you can see here, I use a 20 close, this of course, and I use a full black line with a 3 here. Because the default is going to be red area, which is going to show you a bunch of area for the correlation coefficient. I find that this is a little bit more helpful. So that's why I have this one set up here. All right, so let's look into different ways that we can trade using this correlation. All right, so to start, we have one here where the correlation coefficient to Bitfinex, this guy here, does go below 0.9, so we are looking to enter a trade. So with this correlation, Bitfinex rate had actually gone up, but the Coinbase GDAX rate had not moved at all. It was actually moving slightly lower. So this is a really good opportunity to buy into the market with a market order. And again, this is one of the only times that you actually do want to use a market order and you do not want to be using a limit order to enter an arbitrage opportunity. Reason for that being, many GDAX bots are going to be trying to arbitrage and become market makers. Because of that, they're going to be using post-only limit orders. If you also use a post-only limit orders, you're going to be competing with getting into the market with all of those bots, which you're probably not going to win. Those bots are going to be faster and quicker and more adaptive than you will be. What we can do is just suffer the fees of 0.25% and buy in using a market order. One other big advantage of trading with arbitrage is the risk reward. The good news about many bots who are trying to trade arbitrage as well is that if many of them want to buy in with bids, with limit orders, what's going to happen is you can put your stop loss just right below all of those bids at the current price, because price is going to have a hard time going below those bids. If, for example, Bitfinex goes up, and let's say the GDAX is staying stable, what you're going to see is a lot of bids entering the market where you have like 20 Bitcoin wanting to be bought at the top bid. If you put your stop loss just, say, 0.2, 0.3% below that, you're probably going to be protected from any loss, because the only way that you could actually have your stop loss hit would be if someone had actually sold through all of those bids who want to buy in to arbitrage the market, and then sold all the way down to your stop loss. And with that amount of demand to try to fill that arbitrage opportunity from bots, that's probably not going to happen unless the market actually changes its direction. So that's why arbitrage actually not only offers really good risk reward, because you're only risking like 0.4, 0.5%, and you're typically making about 2 to 3% per trade. Not only does it offer risk reward, it also offers a really good probability of not having your stop loss hit because of that high demand to buy, or high demand to sell if it was the opposite kind of opportunity. So here the Bitfinex rate had gone up. The GDAX rate was moving down. This is where we want to buy in and maybe just put a stop loss a little bit below here. If you had done that, actually, price doesn't even go down to 84.80 here. Price actually just immediately goes back upward. So this inconsistency in the market was filled. So basically all you're looking for with this strategy is look for dips below the 0.9 between GDAX and Bitfinex. When you see that happen, you can open an arbitrage trade. These kinds of opportunities are probably not ones you want to get into if you're purely trading arbitrage because they're not really good enough. Really, the lower that the dip occurs with the correlation coefficient, meaning the more inconsistency there is in the two exchanges, the better the trade is going to be. For example, here, the correlation was very, very off. It was at about 0.83. You could have sold here before everyone else had sold into this downtrend. And we're going to be talking about this a little bit later. Where do you exit with your arbitrage? Let's say you had bought in here. You're going to want to exit probably with a limit order and not with a market sell order. Because as you can see here, when the correlation coefficient goes from about 0.98 to 1, right now it's currently at 0.9921 with this example here. When it goes from about 0.98 to 1, basically the exchanges are moving in tandem. That means that the inconsistency in the market has been filled and the arbitrage is over. However, you can actually stay in the trade and just move up your stop loss, move up your take profit if you would like to. That would require some technical analysis know-how and also just some confidence in your trading as well. But again, this strategy does not require any massive amount of technical analysis besides the basics. And it really doesn't, you don't need any other kind of analysis to do this kind of thing, to trade these kinds of inconsistencies in the market. One more thing, a question that you might have is, when do I enter? I see that, the correlation coefficient is below 0.9, but when exactly do you enter? Well, you actually want to enter when the correlation coefficient goes down and then slightly moves up. Because what that shows you is that the GDAX Coinbase rate is beginning to conform to the Bitfinex rate. What that's going to do is that's going to prevent you from buying in like here, when Bitfinex was actually moving up, preventing you from buying in from like here, and actually only buying you in about here-ish, these two candles. If you had waited for that slight amount of beginning for Coinbase to begin to conform to Bitfinex, then you would be buying at an optimal price. Okay, here we have a much more dramatic example where the correlation coefficient to Bitfinex goes to about 0.6, I think 0.68, 0.67, down to here. The market's consolidated on Coinbase, but on Bitfinex, the price was up here. And again, the correlation coefficient does not say whether the price is down or up. That I'm going to be showing you guys a different tool to gauge what is happening there. It just shows you the correlation. It does not show you positive, not positive or negative, because it shows you positive and negative here. It doesn't show you if price has gone up or down. So you'd actually need to look at the Bitfinex site or Bitfinex price and see if it went up or down. Bitfinex went up. Correlation coefficient goes down naturally because Coinbase did not go up as well. This is a pretty good trading opportunity. When price is consolidating, but the leading exchange actually already went up, there's a pretty high probability that this is probably going to go up as well, and you can snag maybe a 2 or 3% profit off of that inconsistency in the market. Two possible points of entry. Here would have been great. The correlation coefficient is beginning to conform, meaning Coinbase is beginning to conform to Bitfinex right there. So you could have bought in about this area, or here as well, which would have been that downward candle. You could have bought in there. If you had, you would have had that. About a 3% total profit. Your stop loss could have been easily 0.3, 0.4%. It would not have been hit. If you had bought here, your stop loss would be here and you'd be fine because there'd be enough bids to keep price from going any lower. High demand. When would you sell? You'd probably want to post a limit sell order around here when the inconsistency in the market's been, I think 99.5%, 99.57% filled. So the correlation here is 0.9957. You could stay in the market if you believe that Bitcoin is going to continue going up because of technical analysis. But the arbitrage opportunity itself is over. So this would be a good place to post your limit sell. With this strategy, you'd be market buying here, and you'd be using a limit sell order here. Your total fees would just be 0.25 for that buy order. So you make about probably 2.6 to 2.7% profit on that trade within a matter of about half an hour. So pretty good trade right there. All right, so let's go into another example. Price is consolidating on Coinbase. Bitfinex actually went down here. Correlation coefficient naturally goes down as well. Unfortunately here, there was not a lot of pause before the Coinbase rate Coinbase GDAX rate just crashed or went down quite rapidly. If you had waited for a slight up move, or if you had waited for this to move sideways, the correlation, you probably never would have gotten in before this occurs. So there really are two ways you can try to trade correlation and arbitrage. You can try to be very aggressive and try to target these kinds of moves of selling right before everyone else sells, or you can be a little bit more calmer and trade this kind of way. It's completely up to you. As much risk tolerance as you would like to take. So that's what occurred here. And the market just continued moving downward even though the correlation was here. And of course, that occurred because the correlation does not care whatever way price is moving. It doesn't even signal reversals. It just signals inconsistencies in the market. And here GDAX and Bitfinex were both moving down. So you get that. All right, so that's the first method of basically just looking for correlations and inconsistencies in the market and then trying to trade against them. And actually, there might have even been a very, very recent arbitrage opportunity about here-ish, where you could have bought in here before the inconsistency in the market was filled. So Bitfinex actually went up here. This is just a case in point kind of thing. Yeah, exactly. So Bitfinex, ignore this correlation because it's this is going to be correlation of Bitfinex to Bitfinex, so it's going to look kind of random, obviously. But just notice here at 18 o'clock, we had a strong up move, right? And at 18 o'clock here, we had a slightly weaker up move. So this right here would have been where you probably want to buy in, about here. And yeah, another correlation coefficient there. So that's just the first way to trade using correlation coefficients. However, there is one issue with the strategy that you might have noticed. The correlation coefficient does not tell you whether price went up or down. We do have a tool, though, that we can use to find whether price went up or down and still have correlation. So this is just what I like to call x divided by y. So this is, you can just read this for 5 seconds, and let me show you guys how to get this. So you're going to need to use 2 screens for this one. Let's disable this guy, and let's go to 2 screen. So to get this, what you're going to need to do is hit this, type in BTC USD, the Bitfinex one, but hit divide. So we go here, I'm going to click, and then I'm going to click Coinbase. Bitfinex divided by Coinbase, enter. So now we have Bitfinex divided by Coinbase. It's going to look kind of wonky, but I put a horizontal trend line, as you can see here. This is going to be if Bitfinex's rate was exactly equal to Coinbase's rate, the price, the correlation will be there. So that's just a good gauge to see, what's occurred here. And the basic strategy with this is whenever this goes very, very low, you want to sell. Whenever this goes very, very high, you probably want to buy. Because what this means is, I'm going to show you guys a direct example of this, what occurred here. And the tails do matter. These tails are incredibly important. They're not random. Let's say that this went very, very high up. What that means is that the Bitfinex rate actually went much higher than the Coinbase rate at this point in time at 8.15. And then right immediately after, the Coinbase rate actually went up. You can see the correlation goes from like whoosh, all the way back down to here. That occurred because the Coinbase rate actually quickly matched the Bitfinex rate within a matter of minutes. That would have been your buying opportunity before this occurred. You would buy here. All right, so let me show you guys that example that I'm talking about here. So notice here at 2055 on both charts, we have that very, very low tail, very, very low tail here. You might be wondering, well, did this move already occur? Not exactly, because this move had not occurred at 2055, which would be 8:55 p.m. Eastern for those who don't know military time. So what had occurred was Bitfinex's rate at 2050 had gone down this kind of style, this kind of percent as well. But the Coinbase GDAX rate had not gone down that amount yet. That's why this tail was printed. It was a quick little, I would say, arbitrage opportunity of maybe like 20, 30 seconds where you could have sold before this rapid 0.7% decrease in price occurred. To go one step further, you could even do something a little more advanced where instead of selling, you could say, all right, on GDAX Coinbase, I want to actually buy in. Will my buy order probably fill? And before this move even occurs, this is dangerous, of course, but if you know what you're doing, you can do it. You can put a limit buy order much, much lower here because you're expecting many people to sell because they already did on Bitfinex. That is one way you could do to try to get your orders filled, where you're not really trading arbitrage, but you're just really using it to get your orders filled. But if you want to actually directly make profits off of arbitrage, this is a pretty good case study of how you would do it. Yeah, so let me just end this video with just a few more examples, and yeah, again, happy happy arbitrage trading. So if we look here, with that second more just advanced example here, let's go to, we have Coinbase right here, and we have this, 2030, 323. Let's go to Coinbase 2030, 323, 2030. Yep, so it's right here, and you can see that I have them overlaid on the same. This is not a fantastic example, but basically what had occurred here was price was actually trading here because this is the close. And then the Bitfinex rate had gone up very quickly, but the Coinbase rate had not. So if you had bought here, you maybe could have snuck out that little bit of profit, but again, maybe that one wouldn't have worked. And I can just see a lot of examples here, and some really good ones are the ones that go really, really low, like this guy, and especially like this one right here. So this one occurred at 319, 1625. So 319, 16, where is that? You can see my 319, 1625. Yes, that'd be here. Oh, that's good. Yeah, this one's interesting. So imagine that price had just opened here. So price is here. You don't know any of this information. Price is right here. So what had actually occurred was that the Bitfinex rate had just gone right down. The GDAX Coinbase rate was flat here. And this is indicating you to sell right here, right? Because this low tail means that the Bitfinex rate is going down very quickly. There's an arbitrage opportunity. And if you had sold here, I mean, you would have been selling at the best possible price. And then you could have shorted, here, made a nice profit, or just bought back in at a better level. If you had like bought, sold, bought. But yeah, so that's just a more advanced way of looking at this kind of way of doing it, just one divided by the other. By looking at this, even though it looks kind of crazy, I would recommend putting a horizontal trend line at the very one-to-one. I know it all says one, but what you actually want to do is when you put your horizontal trend line, you're going to want to line it up with that part, with that horizontal line on the grid, because that's the actual one-to-one ratio right there. Okay. So one more thing. Let's go to Coinbase. So if you want to use the original example, the original strategy, the correlation coefficient here, what you can actually do is just use a two-screen. And you can have Bitfinex here. And you can have Coinbase on the other. But this doesn't really tell you a full amount of information. That's why we want to add that correlation coefficient, because this is kind of hard to trade, to be honest, to try to look for one goes first or the other. So this is what I'm going to click here. And this is how you maybe would be actively trading correlation coefficient using the first strategy. Yep, and here it is. So this way you can actually, and I also have my settings, as you can see, crosshair interval for sync on all charts. Yeah, so this way you can actually see, hey, does Bitfinex go up or does Bitfinex go down when the correlation rate changes? And then that way you can actually trade. So there are going to be a lot of really good opportunities here. Like this one you could have bought right here and made, I mean, not a beautiful amount of profit there. That's like, I think, 0.35, but that still is just an arbitrage opportunity. And if you were holding and were looking to sell, you could just wait for price to go up there again. That would occur, yeah, right there. So the Bitfinex rate had already gone up, Coinbase rate had not, and that'd be the place to do it. Again, purely trading arbitrage might be tough. You might want to combine this with technical analysis or sentiment or fundamentals, because you're going to want some price context of what exactly is happening and if the arbitrage opportunity is good enough. Again, this is just a strategy that you can use. It's a little bit different than most strategies that I've covered and that most strategies that I think the YouTube creators are going to talk about. So I just wanted to show you guys another way you can trade using correlation coefficients and also looking at one rate divided by the other kind of thing. All right, that's going to be it for this video, and if you enjoyed it, feel free to leave a comment or a like, and also have a great day.